welcome you again in class of the macroeconomics. And in the previous discussions, I have discussed about the GDP measurement, and one of the technique of the GDP measurement already we have discussed that GDP or the national income is measured through the expenditure approach. And in this class, I will be discussing with you about the income approach to measure the GDP. So, we continue the discussion of the gross domestic product, and one of the techniques to measure the GDP is the expenditure approach to measure the GDP. Method or approach. And the second one which we are discussing in this lecture is the income approach to measure the GDP. And the third one, which I will be discussing with you after the second one, is the value-added approach. So these are the three methods to measure the GDP, and as we have already discussed about this one, the second one is that we can also, the economists, they are also measuring the GDP, the national income of the country, by adding up all the incomes earned by the factors of production. The income that if we talk about the circular flow of the income, then there are the households, suppose there are the firms, there are goods markets or consumer markets, and here are the factor markets. That income is circulating in this way. These are the households, these are the actually owners of the resources. They supply the land, labor, capital, and they are also the entrepreneurs. Means owners of the businesses. So they supply these factors to the factor market, from where these sectors are hired or purchased or rented by the firms or the businesses. You can also use the term businesses. So here they hire all these resources, the factors of production. They are flowing from the households to the businesses, and these firms, after using the factors of production, because all the factors of production, these are used to produce the other things or to produce the goods as to provide the services. So the firms, they convert the inputs or the factors, they produce the goods, and these goods are sold to the markets, goods, services, sent to the consumer markets for the purchase, from where the buyers they can purchase all these goods and services. And then again, these goods are purchased by the households. Actually, these are the producers, and these are also the consumers or the users of all the goods. So they purchase the goods, and they also purchase the services. Now, just see that from the households, resources are the factors, they flow to the factor markets. From these markets, these firms, they have hired or purchased the resources or the inputs or the factors of production and converted them into the goods and services, and they have these goods and services again sold to the markets from where the buyers or the households they have purchased or they are purchasing. So this is the one line earn 170. So when these households they supply these factors, they receive the rent for the land, wages for the labor, interest for the capital, and profit for the entrepreneurial ability which they are supplying to the factor markets. And the firms, when they hire these factors, they make the payments. And what they make the payments? They pay for the land, they pay the rent, they pay the wages, they pay the interest, and the profits. And when the firms they produce the goods and sell to the market, they receive the prices of the goods and services which they have sold to the market. And these goods and services are purchased by the households, and then households they are not getting all these things free. Nothing is free. So they pay prices. So from this one, even the government is in between. Government make transfer payments, pensions, retirement funds, and other payments made by the government to the households, and these households are paying the taxes. Firms also pay the taxes. So direct or indirect taxes paid to the government, and then we have also the export and import sector. Imports. So we're not extending this one just simply to understand this one. So there are other things that we export the goods to the other countries, and we add that amount into the GDP when we are measuring, and then what we are also importing. So through this way we can see that if someone is spending, this is the expenditure of the firms. On the other side, someone is receiving. Means households they are earning. So whatever is the expenditure, on the other side, same amount is treated as the income. So again here, if someone is spending to buy the goods and services, the firms they are receiving. So what buyers are paying, on the other side, the same amount is received by the sellers. So that's why we say that when we calculate the income approach to measure the GDP, here we calculate or here we add the types of the incomes. The income earned by the land, and that is the rent. Income earned by the labor, and that is the wages, or even you can say salaries. Income earned by the capital, and that we can say the interest, and the income earned by the entrepreneur, we can say that it's the profit. So when we add up these income sources, we get the GDP. So the expenditure approach means the consumer or the consumption expenditure, the investment expenditure which is the private investment, the government expenditure plus minus X minus M, the exports minus imports. So these are the two methods to measure the GDP, and this one is the income approach. When we add all the incomes earned by the households or the factors of production, so this is called the GDP measurement according to the income approach. So thank you for listening, and in the next lecture, I will be discussing about the GDP measurement according to the value added approach.